Hello guys, this is Sugar's Crypto. On this video, I'm about to show you Warren Buffett's strategy, equation, formula, however you want to call it, to look for undervalued stocks. Now, in order for you to understand what the price represents, when you open the Robinhood app and you see a price on the company that you want to buy, that reflects what people are willing to pay for. That doesn't reflect what the company is worth. Now, before we begin, you guys may want to ask yourself why Sugar's Crypto is buying stocks, especially dividends, because that's the one that I'm looking for. I'm looking for passive income. I'm looking for dividend stocks. The reason why is because right now I'm participating on the Cardano incentive testnet, and I'm delegating my ADA, my quantities of ADA, to stake pools on the Daedalus wallet, incentive testnet wallet, and I'm getting rewarded so nicely that I'm getting like a peace of mind. I'm averaging really high returns per, like, only this month of January was really outstanding. It's like, whoa, I have not had a this much a reward on my money, for any return on my money on any investment I ever had, like as far as passive income goes. And I'm like, if I could find stocks or something else that pays just as much, or something that could give me that kind of more peace of mind, kind of like I wanted to spread a little bit further into other waters, into other places I've never been to. Like stock dividends is something kind of new for me, but right now I'm concentrating on investing, being an value investor, not just being a trader or a speculator. I really want to understand the stock. I want to understand the company. I want the company to make sense to me, and I want the company to have a long-term vision, and I want to be able to see this company thrive in the future. Obviously, I'm not going to invest in a company that I don't see potential of being around for the next 5 to 10 years. Anyhow, and so that's what really pushed me into dividend stocks, and especially when you look for the best stake pools on Cardano, you have to learn to look for the best ROI, the best rate of investments. You have to look for their blocks per epoch. You have to look for the saturation percentage, and I did a video on that, how to look for the best stakes you could delegate your ADA to, because it's very important that you understand that you have to do kind of your research a little bit depending on how well you want to be rewarded. So that kind of like searching and researching and analyzing this stake pool performance had led me to think, if there's a way to analyze staking pools operators, then there's a way to analyze stocks, companies, right? So I'm using right now, I have a window open, and I'm looking at, we're gonna do the example with Cisco, and we're gonna go step by step. Cisco right now is trading at $48.87. Remember that quantity of money that you see on the screen right now for Cisco for $48.87 is not what it's worth. It's what people are willing to pay for. It's the market price. People are buying and selling the stock at that price, but that doesn't determine whether this price is the legit price that you pay for this stock. Now I'm going to show you guys how. Now Robinhood app doesn't really go into the details when it comes to the net income, the earnings per share, the PE ratio, the book value. It doesn't have none of that. It does have basic understanding. For example, it does have like the CEO, the employee numbers, the dividends they paying. It does have the price per earning ratio, but we want more than that. We want to look for the book value, because the PE ratio is gonna give you guys the rewards, what's gonna be rewarded for. Now the book value is gonna be the margin of safety, okay? And we want that too, because you don't want to buy in an investment that gives you higher returns, but your safety margin is off the grid. It's like not really good for you, right? So it does have like analyst, and it does have some earnings shown here and whatnot, but it really doesn't go into a detail what we want to look for. Okay, so right now I'll open another tab, E-Trade. E-Trade, I didn't even log in. I don't even have an account with them. I don't even have anything to do with them, but I do go on their investment types, and I go into their stocks, and I put Cisco, and I look for Cisco right here. Okay, so what we want, if you guys want to see right here in this chart right here, we want to, okay, I know that we have the earnings per ratio. We can use it because it's already been, the mathematical equation has been done for us. But if you ever need to look for the PE ratio yourself or how to do it, it's basically you divide the share market price by the earnings per share, by the EPS, and then you come out with the PE ratio. Okay, so let's move the PE ratio from here. So the PE ratio for Cisco is right here in this snapshot right here, is it's trending the 12 month. Let's use 12 months. So it's 17.65. You see, it's a little different from the Robinhood app. Is the Robinhood app is at 19.11. Now, who's right? We don't know. That's why it's good that you do your own homework. That's why it's good that you kind of you do your homework. So let's say the market price is at let's see, at 48.87. So let's click right here. 40. Let's give me one. Bear here with me. 48.87. Right, divided, let's divide that, right, by the earnings per share. So we go here and we look for the earnings per share. The earnings per share right here is 2.718. So let's go back over here, 2.718. All right, so we're gonna equivalent. So let's get the calculator out, right? Because we need a calculator. So we divide the share market price 48.87, right, divided by 2.718. You get 17. Oops. Let's get that calculator back out. Let's put it right here. 17.98. Let's just use those numbers and let's go over here, and it's kind of close. You see, this is 17.65 and we get 17.98, so it's close. Let's go by our mathematical. Let's go by our numbers. Let's not just go by their numbers, because you never know, right? So let's the share outstanding. Well, we're gonna look this. So this is the PE ratio, right? This is the PE ratio, right? So what we're gonna do, I did a sheet right here on this side where we're gonna click. We're gonna put this number right here. I'm about to explain this in a minute, but let's just gather all these numbers, right? Pardon. Let's grab all these numbers, right? And then we're gonna compare. We're gonna go into the detail. I'm gonna explain to you guys, okay? So now that we found the PE ratio, let's go to the second equation, which is the share outstanding divided by the total equity to look for the book value, right? So the share outstanding is 4.2 billion, right? 4.2 billion. So let's write 4.2 and let's write the billion, right? Divided by the total equity. So where do you go to get the equity? Because the equity is not here. Do you guys even know what an equity means, guys? Well, if you go to, let's see real quick. If you go to the if you go to the fundamentals, and you got to look at this at the balance sheet, right? Because the balance sheet, the total equity is the assets minus the total assets minus by the total liabilities. That it gives you the equity, all right? So the asset total is right here. So in the assets, you'll see the cash, their income, their investments, long term, short term. But you want to look for the total asset, okay? So if you scroll over here, it gives you the annual or quarterly. We're doing annual because the EPS is based on the last 12 months of last year. So we're gonna go by the 2019 right here at the very corner. So we're gonna scroll down to total asset. It's not, and then you gotta make sure down here is value are displayed in the millions. So make sure it's in the millions. Now, I've seen a lot of people make mistakes where they think that just because it says 97,793, they think that's 97 billion because they think that that's what it is, and that's not right. It's 97,793. So let's go back over here. 97,793, right, million. All right. We don't have to really do it because right here it gives you the answer at the bottom. So the liabilities is 64,222. So, but I'm gonna do this for you guys right now. So minus 64 million 222,000. So we're just gonna ignore the 4.2 billion. We're not gonna divide that just yet. We'll divide it in just a sec. We just want to make sure that it's giving us the right answer here, guys. So let's grab the 97,793,000. That's 97,783 minus 64,222,000. That gives us a total of let's delete this and let's write that down. 33,571,000 in equity, right? Dollars in equity. So let's go back over here. Let's scroll down right here. It says the liabilities right here, and then the shareholder equities right here. You scroll down to total equity right here, and it's 33,571. Let's see if we got it correct. 33,571,000. So we got it. So we're gonna. So that's what we have. So now what we're gonna do is we're gonna divide the 4.2 billion, the share outstandings, by the total equity. So let's look for the calculator here. Okay, so let's do 4,200. That's a million. 000 is 1,000. 000 is 100. So let's revise. 100,000 million billions. Okay, that's 4,200,000,000 divided by 33,571,000,000. You get an equivalent of 125. Sorry, let's go 125. Let's just put 125. 125. So we got it here. Let's make sure we did it correctly. I want to make sure we do it right. Okay, 100,000 million. Okay, divided by 33,571. Yep, that's correct. That's what we got. So the book value is 125. Okay. So now the third equation is the share market price. Divide the share market price, right, by the book value. So the share market price, remember, is $48, right, and 87 cents, right? Divide by the book value that we found right now is 125. Okay, the book value. Let's put the BV, that way you guys don't get confused. The BV, and right, we're looking for right now is the price to the book value. Okay, so let's look at the calculator out. And we're gonna divide the share. If you want to write these things down, you can. This is why I did this, so you guys could write it down, pause it, go back, and try to redo this, because I'm gonna give you guys explanation detail by detail how to do this. So bear here with me. So $48.87 divided by 125 is 0.039. 0.039 or 0.39? 0.39. Let's just do 0.39. So let's 0.39. So now that we have that, right, now let's go back right here to this chart that I have here, and we're gonna input these numbers on this chart. We already put the price to the book value right here. We already did that. We already did this, right? The price per earning, the price earning ratio. We already did that, right? So now we're gonna input here the price to the book value, and I'm gonna go into details. Okay, so 0.39. Oops, pardon. 0.39. All right, so that's what we got for as the price to the book value, right? So like remember what I said to you guys. For every price to the earning ratio dollar you spent buying the stock, you should receive $1 in profit in a year, in the year later. Okay, the more you spend for their PE ratio, you're gonna earn less. For example, like right here, 25 will give you a 4% as a reward. 20 will give you a 5% as a reward. 15 will give you 6.6 as a reward. So the lower the PE ratio gets, the higher reward is, of course, because if you pay $5 for this company, you get $1. That's 20%. Warren Buffett's favorite PE ratio is under 15. So he wants more than 6.6%. So that's how you know. So and you, like I said, you go back into the E-Trade and you look at their you go to into their snapshot, and you can see, let's go to the snapshot, and you can see already from just viewing it right here, it gives you the PE trailing 12 months is 17.65, which is not terrible. It's not so far away from Warren Buffett's profitability, which is at 15. So as a reward, it's pretty good. Now let's check the price to the book value. The price to the book value on this company is 0.39, right? So according to Warren Buffett's price to the book value, if you get 5, you get 20% safety. If you get 3, you get 33% safety. If you get 2, you get 50%. So the lower you go as the price to the book value, the higher your safety margin of safety is. So if this is 0.39, this has got to be like 100 and 155, 160. So this is a very safe company to buy. Cisco is a very safe company to buy, and as a reward, it's not bad. It's not bad. It's probably like around 6. As a reward, it's probably 6%. Of course, Warren Buffett's like it's 15 PE ratio, and it's a 6.6. So I hope you guys understand this. I hope everything makes sense to you guys. I'm sorry that if everything seems a little confusing, but like I said, if you want, you could go back a little bit and rewatch this video, and all you will need to find is those three equations. But some, like I said, the book value, some platforms have it, some companies have it, some platforms don't. And the total equity, you know where to look for already. You look for fundamentals, and you go to the balance sheets, and you scroll all the way down to the bottom, and you look for that total equity. And if you don't trust it, just do the math work yourself. Like I said, just minus the assets, minus the liabilities, and you get the results. So, and that will give you the total equity. And to look for the book value, the price to the book value, you have to divide the share market price divided by the book value, and you get the price to the book value, which is different than the book value. The book value is different than the price to the book value. The one that we need to want, the final ones that we need to get, is the PE ratio, which gives us the reward percentages, and the price to the book value that gives us the margin of safety. Of course, you got to look at their dividends also, if their dividends are going high or low. And of course, if their dividends see 2.92, that to me, that's pretty good. I mean, I think anything is good. I think this is better than inflation. Inflation is like around 2.34% or something like that. So I'm barely keeping up with inflation, when it comes to dividend. But as a the charge on this company it has performed pretty well. Over the long term, obviously, all the companies tend to do so. I don't know what's wrong with this chart here. I don't really trust it. But let's go to the Robinhood maybe. The 5-year chart on this one, it goes up. So you'll make money by holding the stock, over time. But if it pays you a good dividend, you compound, and you can reinvest those gains back in the stock, or another stock that you may prefer. But basically, you do your homework. You know that the stock is giving you a fair amount of rewards, and is giving you a very high percentage of margin of safety. This is Sugar Subscript. If you like this video, please subscribe and hit that like to support this channel. This is taking me a little while to learn it and giving it to you guys. So that's why I've been taking a long time to upload a video like this, because it's very, very hard for me to learn it myself. And it's even harder for me to present it to you guys. So I hope you appreciate this video. Thank you very much. Leave a comment description below if you have a stock that pays high dividend, that has a good margin of safety, and it has high rewards. Take it easy, guys. Peace out and take care.